If you live in Europe and you've been putting off investing because you don't know where to start, which funds to pick, or which broker to use, this video is for you. Over the next few minutes, I'm going to walk you through exactly what ETFs are, how to pick the right ones, and where to actually buy them as an investor living in Europe. No jargon, no fluff, just what you need to get started. Quick heads up before we dive in. Nothing in this video is financial advice. Everything I share here is based on my own experience and research, purely for educational purposes. Everyone's situation is different, so make sure you do your own research and consult a professional financial advisor if needed. This video covers three things. First, what ETFs actually are and why they make more sense than picking individual stocks for most people. Second, the key metrics and concepts you need to know to pick the right ETF. And third, how to think about building a simple starter portfolio and which brokers European investors actually use to buy ETFs. Stick around to the end because the broker section will save you a lot of time and confusion. So let's start with the basics. What's an ETF? An ETF, or exchange-traded fund, is essentially a basket of stocks that trades on an exchange just like a regular stock. Instead of buying shares in one company, you're buying a small slice of hundreds or even thousands of companies at once. That's it. Simple concept, powerful result. Now, why would you choose an ETF over just picking individual stocks? Three reasons. First, diversification. When you own a broad ETF, you own a small piece of hundreds of companies across different sectors and countries. If one company collapses, it barely moves the needle on your overall portfolio. Second, lower risk from individual company failures. Think about Nokia. At one point, Nokia dominated the mobile phone market. Then the smartphone revolution happened and the stock collapsed. Or Kodak. They owned film photography, missed the digital shift, and went bankrupt. If you'd held either of those as a single stock, you'd have taken a serious hit. If you'd owned a broad ETF, those crashes would have been tiny blips in a much larger basket. And third, simplicity. You don't need to research dozens of companies, follow earnings reports, or rebalance your portfolio manually. The ETF does that for you automatically. For most people building long-term wealth, ETFs are the most efficient and stress-free path. Alright, now the part that actually matters. How do you pick a good ETF? I'm going to walk you through the key metrics one by one. And the good news is, you can find all of this information for free on one single website, JustETF. Now, quick disclaimer here. I'm not sponsored by JustETF. I'm not getting paid and I have no affiliation with them whatsoever. I'm mentioning it purely because it's the tool I personally use and find most useful for European investors. That's all. JustETF is a European ETF screener that gives you all the data you need in one place. I'll show you exactly what to look at. ISIN and Domicile. Every ETF has a unique identifier called an ISIN, International Securities Identification Number. Think of it as the ETF's passport number. When you look up an ETF on JustETF, the ISIN is one of the first things you'll see. The domicile tells you which country the fund is registered in. For European investors, you'll mostly see ISINs starting with IE, that's Ireland, or LU for Luxembourg. These are the most common domiciles for ETFs sold across the European Union, and they matter because they affect how dividends and taxes are handled. UCITS. You'll also see the term UCITS everywhere. It stands for Undertakings for Collective Investment in Transferable Securities, which is a mouthful. So just remember, it means the ETF follows EU regulations for investor protection. As a European investor, always stick to UCITS ETFs. They're standardized, regulated, and available across the European Union. Accumulating versus distributing. This is one of the most important decisions you'll make when choosing an ETF, and it comes down to what happens with dividends. An accumulating ETF automatically reinvests dividends back into the fund. The money stays in, it compounds, and you don't have to do anything. A distributing ETF pays dividends out to you as cash on a regular basis. For most long-term investors in Europe, accumulating ETFs are the simpler choice. Dividends are reinvested automatically, compounding keeps working, and you typically have less administrative work when it comes to reporting. That said, tax treatment varies by country, so always check the rules where you live. On JustETF, you'll see this labeled as distribution policy. Look for accumulating or distributing. Replication method. This tells you how the ETF actually tracks its index. Now, before I explain replication, let me quickly clarify something that confuses a lot of people. An index and an ETF are not the same thing. The S&P 500, for example, is just a list, an index. It tracks the performance of the 500 largest companies in the United States. You can't buy the S&P 500 directly as an index. What you can buy is an ETF that tracks this index. So iShares Core S&P 500 UCITS ETF or Invesco S&P 500 UCITS ETF. These are two different funds from two different companies, both trying to replicate the performance of the same index. So we're talking here about the same destination but different vehicles. And this is where replication method comes in, because not every ETF tracks its index in the same way. There are two main replication types. Physical replication means the ETF actually buys and holds the underlying stocks in the index. What you see is what you get. This is the most straightforward and generally preferred approach for a core holding. Synthetic replication uses financial contracts called swaps to replicate the index performance without directly holding the stocks. It can work fine for specialized exposures, but involves counterparty risk, meaning you're relying on another party to honor the contract. For your core portfolio, stick to physical replication. On JustETF, this is labeled as replication method. Remember that I said before, synthetic replication uses financial contracts called swaps to replicate the index performance without directly holding the stocks? Now, let me quickly explain what a swap is, because it sounds more complicated than it is. A swap is basically a contract between two parties, usually the ETF provider and the bank, where they agree to exchange returns. The ETF provider says to the bank, "You give me the performance of the S&P 500 and I'll give you something else in return." That can be, for example, cash, the return on a different basket of securities, or a short-term interest rate. So instead of the ETF provider actually going out and buying all 500 stocks, it just holds this contract with a bank that promises to deliver the index performance. That works, but you're now relying on that bank to honor the agreement. And that's the counterparty risk I mentioned before. If that bank runs into serious financial trouble, there's a risk the contract doesn't get honored. It's not a common scenario, but it's a real one. And for a core long-term holding, most investors prefer to just own the actual stocks directly through physical replication and avoid that layer of complexity altogether. TER, or Total Expense Ratio. The TER is the annual fee you pay to own the ETF. It's deducted automatically from the fund. You never see an invoice, but it compounds against you over time. And the difference matters more than people realize. Imagine 10,000 euros growing at 6% per year over 30 years. A TER of 0.20% versus 0.50% sounds like a tiny difference, but over 30 years, that gap can cost you several thousand euros in lost returns. For passive core ETFs, keep the TER as low as possible. Look for anything under 0.30%, ideally under 0.25%. On JustETF, this is labeled as TERPA per annum. Fund size and inception date. Two more things worth checking. Fund size, also called AUM, which stands for Assets Under Management. This tells you how large the fund is. Larger funds are more stable, less likely to be closed, and typically have better liquidity, which means tighter spreads when you buy and sell. The spread is the gap between the bid price, what buyers pay, and the ask price, what sellers want. A smaller spread means lower trading costs. As a rule of thumb, look for funds with at least 500 million euros in assets under management, ideally over 1 billion euros. The inception date tells you how long the ETF has been running. Older funds have a longer track record and are generally more established. A fund that launched 6 months ago has no history to evaluate, so you have no historical data to judge how it performs across market cycles, to assess management consistency, or verify long-term expense impacts. On JustETF, both indicators are labeled as fund size and inception date. Finally, let's talk about three important risk factors that can affect your returns. Strategy risk is about how the ETF actually invests your money. Most ETFs are long only, which means you buy stocks and hope they go up. That's simple, but there are other strategies out there. Some funds use leverage, basically borrowing money to amplify gains and losses. Others use short selling, which is betting that stocks will fall. These are advanced tactics that can turn your investment into a speculative game. For your first ETF, you want long only. Buy it, hold it, let it grow. Fund currency. Here's what this actually means. When you buy an ETF, you're buying it in a specific currency. Think of it like this. You go to a shop and the price tag is either in euros or dollars. If you buy a European fund, the price is in euros. If you buy a US dollar fund, the price is in US dollars. Since you're in Europe earning euros, a European fund is usually easier. You just pay in euros and no conversion is needed. A US dollar fund would mean your broker converts your euros to dollars first, which adds a small fee. Currency risk. This is the tricky part, so pay attention. Let's say you buy a European denominated fund that holds US tech stocks. You paid in euros. Great. But here's the thing. Those US stocks are priced in dollars. When the dollar gets stronger against the euro, those stocks become more valuable in euros. Bonus for you. When the dollar gets weaker, they become less valuable, and that's not good for you. That's currency risk. An unhedged fund means you're exposed to this currency swing. It could help or hurt you. A hedged fund is like buying insurance. It locks in the exchange rate, so currency swings don't affect you. But that insurance costs money, so hedged funds have slightly higher fees. For most European beginners, European or euro-denominated unhedged funds are fine. You get simplicity and you're not paying extra for hedging. Just know that if your fund holds international stocks, currency moves will play a role in your returns. Alright, you now know what an ETF is and how to evaluate one. Now let's talk about how to actually build a simple starter portfolio and where to buy. The simplest and most proven approach for a beginner is what's called a core satellite structure. Your core is 70 to 90% of your portfolio, a broad, globally diversified accumulating UCITS ETF. This is your foundation. It gives you exposure to hundreds or thousands of companies across the world in one single fund, at low cost with minimal effort. Your satellite is the remaining 10 to 30%, Optional tilts towards specific regions, sectors, or themes. Emerging markets, European stocks, tech sector, whatever aligns with your view and risk tolerance. This is where you can add some nuance if you want, but keep it small and keep it intentional. For most people starting out, just the core is enough. You don't need to overcomplicate things. Let me walk you through two of the most popular options for European investors. First up, iShares Core MSCI World UCITS ETF. The ticker is EUNL, IWDA or SWDA, depending on the share class or listing. Always check the ISIN to find the exact ETF. This one tracks the MSCI World Index, which means it covers developed markets only. So you're getting the US, Europe, and Japan, but no emerging markets. The TER fee is around 0.20% per year. It physically owns the stocks it tracks, and it's based in Ireland. Here's the thing that makes this fund so popular. It's absolutely massive, over 60 billion euros in assets. That means it's cheap to buy and easy to sell. The trade-off? You're missing emerging markets like China and India, which are growing really fast and represent a bigger chunk of the global economy every year. Now the second option, Vanguard FTSE All-World UCITS ETF. The ticker is VWCE. This one is different because it tracks the FTSE All-World Index, and the key word here is all. You get developed markets and emerging markets in a single fund. China, India, Brazil, it's all in there. The fee is slightly higher at around 0.22% per year, but it also physically owns its stocks and also based in Ireland. So which one should you pick? If you want the absolute lowest cost and you're happy without emerging markets, go with the MSCI World. If you want true global coverage, everything in one fund, no thinking required, VWCE is your answer. Honestly, both are excellent. The fee difference is tiny. We're talking about a few euros per year on a €1,000 investment. What really matters is that you pick one, set up automatic contributions, and just stick with it. One of the most important habits you can build as an investor is automating your monthly contributions. Most brokers in Europe let you set up a recurring investment. You decide the amount, you decide the ETF, and the broker buys automatically every month on your behalf. You remove the emotion, you remove the temptation to time the market, and you let compounding do its job. Small, consistent monthly buys beat trying to pick the perfect moment every time. There are several brokers popular with European investors. Here's a quick overview. But do your own research on each one to find what fits your country and situation best. Trade Republic, a European neo-broker with low trading costs and a clean mobile app. Popular across multiple European countries. Good starting point for beginners who want a simple user interface. Scalable Capital, another popular European broker with a similar low-cost model. It has received a German banking license, which adds a layer of regulatory oversight, and it also offers automated investing plans. DEGIRO, known for very low trading costs per transaction. Good for investors who want to buy manually rather than automate. Read their custody documentation carefully to understand how your assets are held. Interactive Brokers, more advanced platform with global reach and very competitive foreign exchange conversion costs. This one is better suited for investors who want more control and are comfortable with a more complex user interface. Now, before choosing a broker, check three things. Whether your chosen ETF is available on that platform, what the fees are for buying and holding, and whether the broker supports your country of residence. Let me make this as simple as possible. 3 things to do after watching this video. 1. Go to JustETF and search for VWCE or EUNL. Open the ETF page or fact sheet. and check the ISIN at the top so you pick the exact share class on the exchange you want. Note the TER, the assets under management, AUM, the replication method, and whether it's accumulating or distributing. 2. Pick a broker. Start with Trade Republic or Scalable Capital if you want something simple and beginner-friendly. Open an account. It will only take you about 15 minutes. 3. Set up a monthly contribution, even a small one, 50 euros, 100 euros, whatever you can consistently afford. The amount matters less than the habit. Start now and increase later. That's your ETF starter guide for European investors. We covered what ETFs are and why they beat individual stock picking for most people. The key metrics to evaluate any ETF, UCITS, accumulating versus distributing, TER, fund size, replication method, strategy risk, fund currency and currency risk, and how to find all this information for free on JustETF. And we looked at 2 of the most popular core ETFs used by European investors, plus a quick overview of brokers. If you have any questions, drop them in the comments. Which broker are you using or considering? Which ETF are you looking at? Leave your answer in the comments and I'll follow up. And if you want me to go deeper on any of these topics, a full broker comparison, a hands-on walkthrough of JustETF, or a deeper dive into accumulating versus distributing ETFs, tell me in the comments and I'll make it. Subscribe so you don't miss it, and I'll see you in the next one.